Have you ever wondered if a machine could beat the greatest investor of all time? We're talking about Python-powered AI versus the legendary Warren Buffett. It's the ultimate showdown. Silicon brains against the Oracle of Omaha. Could an algorithm, meticulously coded and running 24/7, really outperform decades of human wisdom, intuition, and discipline? Today, we're diving deep into this fascinating battle. We'll break down how algorithmic trading works, what makes Warren Buffett's strategy so timelessly successful, and then we'll put them head to head. By the end of this video, you'll have a crystal clear understanding of which approach might be better for your own financial future. So, grab your notebooks because class is in session. Let's start with the challenger, algorithmic trading, or algo trading for short. Picture this: instead of a human staring at charts, making emotional decisions, you have a computer program. This program is built on a set of rules, mathematical models, and historical data. It can be as simple as buy this stock if it drops 5% and sell if it rises 5%. Or it can be incredibly complex, using machine learning and AI to identify patterns humans would never see. These algorithms are lightning fast. They can execute thousands of trades in the time it takes you to blink, capitalizing on tiny price movements that are gone in an instant. This is the world of high-frequency trading, where speed is everything. The biggest advantage? Algorithms have no emotions. They don't get greedy when the market is soaring, and they don't panic sell when things look grim. They stick to the plan, day in and day out, with unwavering discipline. This removes one of the biggest hurdles for human investors, our own psychology. We're wired to follow the herd, to buy high out of fear of missing out and sell low in a panic. An algorithm feels none of that. It just follows its code. Plus, these systems can analyze vast amounts of data simultaneously: news articles, social media sentiment, economic reports, and technical indicators far more than any human ever could. This allows them to make highly informed, data-driven decisions in real time. It's a powerful tool, no doubt. But this power comes with its own set of problems. First, creating a consistently profitable algorithm is incredibly difficult. The market is not a fixed system. It's a dynamic, chaotic environment influenced by human behavior. An algorithm that worked perfectly last year might completely fail this year because the market conditions have changed. This is called overfitting, where a model is too closely tailored to past data and can't adapt to the future. It's a constant cat and mouse game where developers must relentlessly update and refine their strategies. Second, there's the risk of flash crashes. If a powerful algorithm has a bug or misinterprets a piece of data, it can trigger a chain reaction of automated selling, causing the market to plummet in minutes before anyone even knows what's happening. We saw this in 2010. It's a stark reminder that while machines are fast, they lack common sense. They do what they're told, even if it leads to disaster. And finally, the high-frequency trading game is an arms race. The big investment banks and hedge funds spend billions on the fastest computers and the most direct data feeds to gain a millisecond advantage. For the average person trying to compete with a simple Python script, it's like bringing a go-kart to a Formula One race. You're simply outgunned. Now, let's turn to the reigning champion, Warren Buffett, the Oracle of Omaha. His strategy is the polar opposite of high-frequency trading. He doesn't care about millisecond advantages or daily price swings. In fact, he famously said, "Our favorite holding period is forever." Buffett practices what's known as value investing, a philosophy he learned from his mentor, Benjamin Graham. The core idea is simple: buy wonderful companies at a fair price. He's not buying stock tickers, he's buying pieces of businesses. So, how does he do it? Buffett and his team at Berkshire Hathaway do immense, deep dive research. They look for companies with a durable competitive advantage, something he calls a moat. Think of Coca-Cola's brand power or Apple's ecosystem. These are businesses that are difficult for competitors to attack. He wants to see strong, consistent earnings, low debt, and competent, trustworthy management. He's looking for companies that he can understand inside and out. As he says, never invest in a business you cannot understand. Once he finds such a company, he calculates its intrinsic value, what the business is truly worth. If the market price is significantly below that value, he buys and then he waits patiently. Buffett's biggest advantage is his temperament. He's disciplined, patient, and he thinks for himself. When others are panicking, he sees opportunity. During the 2008 financial crisis, while everyone was selling, he was investing billions into solid companies like Goldman Sachs and Bank of America, which were trading at bargain prices. He has a long-term perspective that allows him to ignore the market as daily noise and focus on the underlying value of the businesses he owns. He's not trying to predict the market. He's betting on the long-term success of great American and global businesses. His track record speaks for itself. For over 50 years, he has consistently beaten the market, turning Berkshire Hathaway into one of the largest companies in the world. But Buffett's approach isn't without its challenges. It requires immense patience. In today's world of instant gratification, waiting years for an investment to pay off can be agonizing. It can also be difficult to find those wonderful companies at a fair price. In a bull market, almost everything can seem overvalued. It also means you might miss out on fast-growing trends, like the tech boom of the late 90s, which Buffett famously sat out because he didn't understand the businesses. While he avoided the dot-com bust, he also missed out on some huge winners early on. His strategy is slow, steady, and some might even say a bit boring. It's the tortoise in a world full of hares. So, the moment of truth. Python AI versus Warren Buffett. Who wins? The answer, like most things in finance, is it depends. It's not about which one is definitively better, but which one is better for YOU and your goals. Algorithmic trading excels at short-term, high-frequency strategies. If you're a sophisticated quantitative analyst with massive resources, you can potentially generate significant returns by exploiting market inefficiencies. The AI approach is about speed, data, and exploiting fleeting patterns. It's a game of probabilities played at light speed. Warren Buffett's approach, on the other hand, is about long-term value creation. It's a philosophy built on business fundamentals, patience, and a deep understanding of what makes a company truly great. It's accessible to the average investor. You don't need a supercomputer or a PhD in mathematics. You need discipline, a willingness to learn, and the emotional fortitude to buy when others are fearful and to hold on for the long haul. Here's the most interesting part. They're not necessarily mutually exclusive. The most successful modern investment firms are actually combining both. They use AI and machine learning to sift through mountains of data to identify potential investment opportunities much faster than a human team ever could. But then, they apply the human wisdom and judgment of the Buffett school to make the final call. The AI can point to a statistically cheap stock, but the human analyst asks, does this company have a durable moat? Is its management trustworthy? Is this a business I want to own for the next 10 years? It's the perfect synergy of man and machine. The AI provides the what, the data-driven signals. The human provides the why, the qualitative understanding, and long-term context. So what's the final verdict for you, the individual investor? While the world of AI trading is exciting, for most of us, trying to compete with the giants is a losing game. The principles of Warren Buffett, however, are timeless and accessible. Focus on what you can control. Live below your means. Invest consistently in things you understand, like low-cost index funds that own a piece of the whole market and hold for the long term. Let the power of compounding do the heavy lifting. Don't try to outsmart the market. Aim to own a piece of it. That's the most proven path to building wealth. The greatest lesson from this showdown isn't about choosing sides. It's about understanding the strengths and weaknesses of each approach and applying the right principles to your own financial journey. Thank you so much for joining me on this deep dive. I hope it gave you a new perspective on the world of investing. If you found this helpful, Do me a favor and hit that like button and subscribe for more content that breaks down complex financial topics. Let me know in the comments below. Which side are you on? Team AI or Team Buffett? I'd love to hear your thoughts. Until next time, invest wisely.